Welcome back to Preparing Financial Statements, Best Practices for Banks. My name is Megan Ruby. I'm a senior here in the Financial Services Practice Group. I'm also joined here by David.
Hey, thanks for having me, Megan. David Stone, Senior Manager in the Financial Services Practice Group as well.
Perfect. Well, we talked a little bit in the last video that we had about what is a balance sheet really telling you. So the big question here as we get into income statements, what is the story behind an income statement? What is it telling us?
Yeah, so Megan, for the income statement, this is really breaking down the net earnings resulting from the activity of a company over a period. You want to make sure that you're breaking out, all those significant income and expense items, including those cash items as well as non-cash items that resulted in the changes to the position of the company. So we have a few things to consider here. First, consider if interest income and expense from significant sources are separately presented. So, sure, you'll have loan interest income, probably investment income. Similarly, you'll have those items on the expense side. But what level of detail are you breaking out these items? And is it granular enough to provide useful information to the readers of the financials? Now, you also want to consider your allowance for credit losses. And we're not talking about your ACL from a balance sheet perspective, but from the income statement perspective. So consider breaking out your ACL, or often called your credit loss expense, by its different components. So you could have the ACL on loans, ACL on off-balance sheet credit exposures, maybe ACL on held to maturity securities. We've seen the credit loss expense for these three components, maybe more, broken out separately on the income statement. And if not broken out separately on the income statement, consider breaking it out in the footnotes. Again, just considering what's useful to the readers of the financials. Now, also consider if categories of income and expense that exceed 1% of the aggregate total interest, income, and other revenues are separately presented. And again, if you're not separately presenting these items on your income statement, consider breaking them out in your footnotes.
Yeah, I think taking a look at any material events or transactions that may have occurred throughout the year that are unusual of nature, should these be broken out as well and be separately presented, maybe due to infrequency of occurrence or just due to the unusual nature? Hopping into the next one, ensuring that the comprehensive income or loss categories, these need to agree to the change on the balance sheet. So we want to make sure, very much like what we were talking about in the last one, telling a very consistent and clear story. Does the activity within the income statement support what we're presenting on the balance sheet and vice versa? Taking a look here at certain line items that need to agree to other disclosures, keeping up with that theme of consistent and clear reporting. These could be that credit loss expense that David was talking about, or income tax expense. So, making sure that what we're presenting on the income statement, if it's getting broken out into further detail in another spot within the financials, we're going to keep it nice and consistent with what we're presenting.
Awesome. Yeah, thank you, Megan. So that concludes the income statement section of our checklist. Thanks so much for tuning in. We hope to catch you on the next one.